Welcome, everyone, to our Markets Happy Hour podcast here in Dallas at the fringes of the Titan private wealth investor event. I'm delighted to be joined by Dallas legend, Christie Townsend, who has formed, I think, quite a persona on, X, Twitter, as an allocator with a sometimes wry observation on the world of allocators and managers. And we've been trying to get this in the diary for some time. So it's been fantastic to get you here. And it was just to tell in terms of what the Markets Happy Hour normally entails. So it would normally be, we run through these five areas, five fingers of the hand. Inflation, interest rates, equity markets. We look at geopolitics, something Christie's been commenting on quite a lot quite recently, I think. And also equity markets and other asset classes. And in terms of the subtopics, so we usually have a few subtopics. Right now, the subtopics we're looking at are inflation expectations breaking away. On the one hand, the inflation looks like it's not under control, but we look where expectations are. They may be looking more under control. We'll look at interest rates. What's next there? We're going to talk a little bit about the new height in money market funds tied to equity markets IPO fever. In our world, that's sort of a problem in that there's never enough supply for the demand. I'm going to speak about geopolitics, what that means for markets, and we'll always be reflecting back on equity market and implications for a portfolio. This is Christie, and she has an over 19 years experience in this arena, and with having worked with one of our audience members here at a children's hospital, and with a long background in Dallas, but equally, as I mentioned, quite a persona as an allocator. So fantastic to have you here. Let's kick off initially with inflation. So the narrative I've been speaking about for some time, because I do this every week, has been around inflation not really behaving as intended and not necessarily coming into check, not helped by the fuel prices, by food prices, all of it related to geopolitics. I think one of the interesting observations just this week has been how the expectations have seemed to have eased a little bit. Whereas on the other hand, there was a desire to keep expectations. There was sort of higher expectations were fueling more purchases, was kind of this vicious cycle. Expectations, for whatever reason, seem to have come down. They're up 50 basis points in 3 months, but not 100 basis points. So they seem to have come into check for whatever reason. And I'd love to ask you then, Christie, in terms of what you see in terms of inflation, is it something a beast that needs to be slayed? Do you think it's somehow coming under control? What is your perspective on how investors should be thinking about inflation today?
I mean, obviously, it's going to be really important. And I think we're kind of at a weird time as well, just given Kevin Warsh coming in as the new chairman of the Fed, who has a very different view on things. And so it's not just, inflation itself and how it, erodes your real purchasing power. It obviously impacts markets in a number of ways, particularly bond markets. But I think there's also the kind of derivative of, as you have this new influence on the Fed, how is that going to impact equities? How is that going to impact bonds? And so that's kind of one that I've been interested in. I didn't know much about Kevin Warsh coming in. I mean, I knew that he's only one person out of, a full board of governors. But I think that there will be a lot of changes. I mean, for example, one of the biggest things that he said when he was in his confirmation is that he doesn't believe in forward guidance. He doesn't like the dot plot. And so granted, that was something that Ben Bernanke came up with back in 2012. I know that there's not, a long history of it, but there is, some level of, market stability and kind of continuity that comes with, I guess markets in general, knowing what the Fed is thinking on some level, even if it's not, in stone and more of a guidance thing. So I think it's kind of an interesting, there will be an interesting flavor as, the Fed kind of transitions. But beyond that, I mean, obviously, like people are struggling, like in the broader sense. How does it impact markets in general? How does it impact people? I mean, I also think that it's really interesting that there's been this shift to go from just kind of PCE to this like trimmed PCE. I think there's like a slow trend towards that. If you looked at the trimmed PCE, which basically lobs off all of the outliers at the top and all of the outliers at the bottom, the Fed is effectively at its goal. It's at 2%. It's like, I think it's a little bit above.
Yeah, it's exactly. And I think that's obviously manipulation of data, right?
Yeah.
In terms of getting getting the numbers that they need to say what you want them to say. And I think you make a very good point about this K-shaped economy, the consumer struggling, consumer sentiment where it is. Does that matter? I suppose is a bigger question, because does it affect? Of course, it matters at a moral level, at a socioeconomic equality level, at a general stability in society level, and it certainly matters to politicians. But does it matter to the market? Does the K-shaped economy matter to the market? I think we all know with IPOs coming down the track, with the rich getting richer, there seems to be this even more divergence. And I suppose, how do you think about that? So the inequality as being a factor that could destabilize things.
I mean, certainly, I think that we have hundreds of years of history proving that. I do think that, I mean, to the extent the Fed cannot clamp down on inflation, which, historically it seems as though they can, but is that kind of a, more so other extenuating circumstances or other factors, in terms of markets being willing to, respond to rate changes or respond to, tightening policy, versus the Fed actually being able to impact it. I guess we'll see. And going forward, do people trust the Fed to continue to, execute on its mandate?
Yeah.
I feel like there's so much up in the air right now. It's very difficult. I mean, obviously it bothers me. It's concerning. I think anytime you see a significant amount of, stock market gains going to kind of one decile of income earners or decile of wealth holders, I think that that's going to be concerning, especially knowing that there are people out there struggling.
It's really interesting, I think, when it comes to the Fed. But I was at an event yesterday with the CIO of Harvard Endowment speaking, and he also shared the view around that the Fed independence was a concern. And I suppose that's one of those things that comes up from time to time, and then it gets the headlines drown it out. And it doesn't seem that it's uncertain as to whether that's going to be a destabilizing debasement trade. It seems like it's not a kitchen table issue, so there's not a huge amount of concern about this. And I'd love to open it to the floor, to allocators, long-term investment participants as well. Are we missing something here? Do you think the markets are missing something here? Anyone have any thoughts?
I think markets are very interesting insofar as their viewpoint on rate cuts and rate expectations and inflation expectations, because at the start of the year, I mean, we were looking at a couple interest rate cuts, and now it's like flipped on its head. So I guess a question to Christie would be, do you think we could see that flip if we see like lower prints of PCE and CPI?
So we're back to rate cuts again?
Right,
yeah.
Exactly.
Well, so I was actually reading the head of the Dallas Fed recently had some very hawkish statements. I mean, just very hyper focused on inflation. And kind of one of the interesting things, I watched Warsh's entire 2-hour Senate confirmation hearing. I would not recommend it. It was, or listen to it at 1.5x. But I think he basically said, I mean, he seemed sincere in his concern about making sure that that under his leadership, the Fed maintains kind of, stability, and that people can trust it. But then I found, I don't want to say but I also looked at an interview he did with somebody at Hoover Institute, which I guess he was a fellow there, probably 8 or 9 months ago, where he basically talked about he is less focused on interest rates and very heavily focused and seemed to lean into more of a monetarist point of view. So the potential to lower rates while tightening the money supply. And I mean, I guess we've done it before, but never in this kind of environment. And so I think it's interesting that as we're looking at inflation, like, again, one person, but he obviously has an outsized voice, who has been hiring people and basically with this focus that it may be that he wants to lower rates, but somehow tighten balance sheet to offset that. So my only point being that I think that he may be trying to have his cake and eat it too, in terms of, following what the executive branch wants him to do, but while also attempting to tamp down on inflation. And I am curious to see how it goes. But one thing I've learned, I never guess or prognosticate about interest rates or where inflation's going, because I feel like inevitably we are all wrong.
One comment that I would have about inflation is that, and I think this speaks to one of the points that you guys were making earlier. So to me, there's two types of inflation. There's Main Street inflation, and then there's the market inflation.
Sure.
So Main Street inflation is and I think what's lost in how it's measured. But if you look at it going prior basically to 2022, if you look back, what people now pay for things has gone up substantially.
Mm-hmm.
But Wall Street inflation is looking at how did it do over the year.
Mm-hmm.
If that went down, or it's a little less percentage. The next thing you have to look at is how is inflation actually measured. So 40% of it is housing and housing related services. So a lot of times you can look at how housing goes, ultimately is often how we start to look at inflation. Now, the question that you always have to also ask when in terms of markets is those companies that have the ability to pass that inflation on.
Yeah.
Makes a very big difference about how the market's doing. And then the other question that you have to ask is inflation can cause higher earnings for companies, but are people willing to pay for earnings that are predominantly inflationary driven because the price level went higher? Those are the things that I think have the questions out there. You know,
That's a great point. I think a fantastic point. And another, what I was just going to say is the transmission effect of monetary policy is not a given anyway either.
Yeah.
They tried that with tightening. It didn't, necessarily, the economy still was firing on all cylinders. And so that's probably a question. We've had the inverted yield curve as a harbinger of a recession. That didn't work out. So I'm wondering, are some of these rules of thumb increasingly archaic and obsolete that we look at as forecasting tools? And just like, maybe should we all take a leaf out of Christie's book and just not forecast at all?
I think rules, yes. I think that trust is always going to be an important thing, though. And so I think to the extent there is some weird about face and the Fed starts, lowering rates in the face of higher inflation, I mean, you're going to lose the long end of the curve at that point. And so it's not a hard and fast rule. It's at the end of the day, investors are wanting to make money. And to the extent you are hampering them from that, you're going to have a real problem with winning their trust. I mean, especially if you're kind of whipsawing them around.
And I'd like to transition now to kind of an economic vibe check. I think that's because obviously the economic vibe check is directly related to how much you pay for things and how much, it costs to borrow. Because clearly we've seen here a headline that mortgage rates climbing to 9-month high, back at 6.56%. So that's kind of at the level that is certainly a far cry from where the lucky few locked in their mortgages in the 2% range. So down here in Texas, been a lot of focus on the housing market, say in Austin, being overdone. And pain in multifamily housing. There's been a lot of focus on some of the Senate primaries down here. We hear whether it's around energy is massively in focus. So I'd love if I could just take a bit of a heat map check in here down in Texas as to what is the vibe? I mean, are we off to the races with the economy and the markets hitting these new highs? Is there a pain on the ground? Are the politicians responding to that? Is something kind of, I suppose, is there a smoke and mirrors element with Austin's boom?
Ooh.
And we can take any one of those random economic vibe check questions or a different angle. But really just to getting a sense of beneath the headlines, what's happening in this massive state here.
I mean, I will say as somebody who did not lock in a super low mortgage rate, paying over 6% sucks. It just does. And there's no other way to say it. I think that interest rates are difficult. They're a tough hurdle to overcome. And so I recognize why people don't want to leave their houses either at this moment, because the ones who did lock in that rate or sub 3% rates, like your payment is going to go up substantially, just period. So I guess on a personal vibe check, I will say, I mean, interest rates are kind of doing what they're supposed to do in that regard, but with some weird kind of pockets. I mean, Texas is always going to be business friendly, right? I mean, obviously with what's going on geopolitically, as an energy producing state, we're probably sitting pretty in that regard, intermediate term at least. But yeah, do y'all have a...
Housing in Austin? It's intriguing to me, having people spoken about Austin as being the boom town. but that behind the scenes, perhaps it's for some firms such as Blackstone were cited as having perhaps, a portfolio that had trouble.
Yeah, so I mean,
The
what
infrastructure.
I haven't at least been able to observe here in Texas, if you look at housing, people are struggling with the same issue, is that you have, let's say, this level of demand that isn't necessarily there because people go, if I leave this house
Mhm.
and I sell my house and I go to get a new one, if it's bigger and it's bigger and I have to pay more for it just on interest rates, it's not going to happen because it's such a sizable difference. And then you have the people who are new entrants into the market going, wow, do I really want to pay that? Do I really want to own? So there's all these questions. I mean, Texas is a great boom economy when it comes to energy,
Mhm.
but our reliance on energy isn't what it used to be.
Yeah.
And there's a lot of charts going like, this
Yeah.
isn't the 1970s
Yeah.
Yeah.
reliance on energy that we have right now.
Yeah.
Unless Houston, like the city itself.
Yeah, but even the cities,
Yeah.
the cities that once were, they're
Fair.
a lot more diversified
Yeah.
than they are.
That's fair.
And the ability to produce energy also has changed from what it was. And I think that piece is often lost when you get to the micro levels. But it used to be when you would go and poke a hole in the ground, there was a chance that you got oil out of it.
Mhm.
Now with shale plays and so forth, it's manufacturing. You know where it is. You just have to figure out, can we get it out? I mean, not can we get it out, but we can get it out how fast, all of these questions. A hurricane in the Gulf does not cause the shocks in prices that it used to.
Yeah.
So the stability and the ability to produce energy
Yeah.
is a lot different than it once was.
We also have a lot of renewables, as you and I talked about.
Right.
Surprising amount of renewables.
Out of Texas.
Yeah.
Yeah.
And just to dovetail what Ryan just said, I mean, from a family office perspective, we're also seeing the same thing. A lot of longstanding oil and gas families, Dallas, Houston, you can even include Austin in that, are moving away from energy and going into real estate because we've just had an influx of people from all over the country coming to Texas, coming to Dallas, Houston, Austin. And so as a result, you've seen this kind of shift in asset class from being energy kind of centric or energy history to more of a commercial real estate or residential real estate. And that's why we've just seen an influx of so much, which could be contributing to prices. But with rates being so high, maybe we're seeing this little dip here in housing. So and we're seeing that across the board, and not just residential, but commercial real estate. Little quick anecdote: the building that we office out of literally sold for 50% of what it was bought like 3-4 years ago because of rates just climbing higher. So
Chilling numbers. I'd say, even for someone who's been an oil and gas family for decades, that, they're used to a bit of boom and bust. It's not like it's a new arena, but still, on the other hand, shifting gears into real estate now, when at the end of the day, there may be an influx, but they still need to borrow money.
Yeah.
So there's, that's going to be a bit of a break on that. I think that those are pretty chilling numbers. And I suppose we talk about a K-shaped economy. Is there a two-speed USA as well? The likes of Texas really having the pro-business, having the tech titans, the data centers, they're moving here too. A lot of focus on Austin as a desirable, despite, not every the tech titans probably don't need to borrow for their houses. So there's an element of that. And then we have the other states, which are just bleeding in terms of population and tax receipts. So it certainly affects it. It probably will be something to watch as we look at going forward. Before I segue to equity markets, I just wanted to put a question again, because Mohammed El-Arian had this comment in the Financial Times just about a week ago saying investors can no longer rely on a policy put. And it brings me back to the Fed a little bit, and not just the Fed, but the Bank of England and other institutions. I think one thing we thought we learned from 2008, because all of us were probably all around then, is that the readiness of institutions to step in. And we saw that with the Bank of England in 22. We saw that with various gestures around the SVB, the regional bank crisis here. There's just been an immediate safety net thrown out, and investors are now perhaps used to that. There's a suggestion here that policymakers are out of juice or out of gas when it comes to that. don't know whether that's Mohammed Al-Arian looking for a headline or whether it is it's something more fundamental. Like, is the safety net still there? We've been going along with the economy doing well for so long. Do you think we can rely on institutions to step up?
I have a really unpopular opinion on this, because I say good. Investors should not have been relying on a policy put in the first place. It created a lot of, backwards incentives for companies and banks to just get larger so that they were in fact too big to fail so that they could get a bailout, whether it's because of their poor management or because of whatever headwind. But in my view, I was raised by an investor, by an entrepreneur. Like, if you mess up, your equity gets wiped out. If you, like, from a bond perspective, like, you underwrite knowing that the max you're ever going to get is set. And so to me, it's really frustrating that there has been kind of these weird little pockets. I will give that 2008 was a different beast because obviously, if you let a bunch of pensions fail, that's going to cause all sorts of ripple effects. I don't want people to hurt, but at the same time, I do think that people need to do a much better job, kind of broadly speaking, not the people in this room, but more broadly speaking, of being able to price their risk and, set it appropriately within their portfolio. And so I do think that there might be some near-term pain, but I think that ultimately this is probably a good sign, at least in my opinion. So again, it's unpopular. I know that, it seems harsh, but I feel like that's how it should be.
It's an interesting moral hazard point. I think actually we're seeing a little bit of that with the, we're going to jump to the private credit funds, gating investors right now.
Yeah.
They're actually making them feel the pain. We've seen it, two headlines just today around, we've seen it with, I'm going to forget about with Blackstone, I think today, and we've seen it with obviously Blue Owl and others. So they're not, there's no safety net there. They'll get their money eventually. The fund hasn't gone under. There is, but is that reminder, I think, that, terms mean something.
It's really important to read your legal documents. Do not forget.
Exactly.
Know the terms of your liquidity.
Yeah.
So I think it's an interesting question you ask about the policy, because it brings you. I think it raises the question: what is the purpose of policy? And if I were to speak on that further, you think back, the policy is what we have relied on. So when there is trouble and so forth, we kind of go, "This is what they're going to do."
Yeah.
So, for example, if you took Silicon Valley Bank and so forth, we're like, "Oh, Silicon Valley Bank is going to collapse." Now, if you had any experience with the financial crisis, you're like, yeah, here's what's going to do. Federal Reserve is going to come in, they're going to do X, Y, Z, and they hit that playbook just in the exact same way. So our ability with policy to address crises, I think that we rely on. The question is, at what cost? Mm-hmm. So, for example, you go back to 2022, yes, we got bailed out of COVID and this pandemic, but at what cost? Now we're paying for it in higher inflation. And that will happen. And what it does create two speeds of economy. The people who have assets, when inflation goes up, they benefit. They become richer. You look at the number of trillionaires you create and so forth. The people who don't have assets stay at the same speed and hurt more because they can't pay for certain things. And then you go, okay, well, when does this break? It's a question. Yeah. And I think that's going to be the question that you're always going to be asking. But we with markets, when the policy decision has to be made, who do you protect? That's the question.
It's not just consumers, it's corporates as well. The corporates get a bailout and their bad behavior or lack of slack governance can continue.
That's a perfect definition of the K-shaped. That was really well played. And just to dovetail that, I think that, from an inflation perspective, we often forget that that's a tailwind for asset holders and a headwind for people who don't have assets. So you really see that division, that divide in inequality there because of that. And it's because of this inflation that we've seen because of the bailouts that we had with the pandemic. The money had to come from somewhere, right? It's wealth is not destroyed, or it has to even out. And so that's a really good description of that.
Yeah. Then on the game, I think you also have game theory when it comes to games.
You taught me this. I love this.
So you put up a fund level gate, right? So I got to worry about what every other investor has to do when they put in. So it makes sense. Put in your redemption. Now you tell me later, is that fun if I go, you know what, I'll stay. Are they going to say, oh, you can't because you put in your redemption? They're going to be like, we love to have you. Glad you're not leaving. But at least now I have a place in line to get out. So it creates this level, but it also, in terms of protection, allows people to have an orderly sales process that could provide investors a better win at the end.
And it is interesting because some of the very big names that have, I think, been exposed to this, and it's not great for their brand. And I'm sure their IR people are having a rather unpleasant time with these discussions, but they are the large names that have the headroom to sustain this and not do something, not shut down or do something in emergency. They should have the buffer there. So in a way, unpleasant as it may be, it's an important test and it is working out. And it is, I think, an important example of consequences of these areas. And hopefully it'll be sustained and will avoid forced selling and that downward spiral. I think we have to move to equity markets. We can't dance around the topic any further, given we've been dealing with this massive momentum and the clearly, I'm sure the people in this room have some view on where we are in terms of momentum. Sorry, this is a little bit small for those of us kind of, but this is basically a chart which shows the $1 trillion club. The obviously Nvidia at the top, with 3 Asian stocks entering that club recent year and recent weeks and sustaining the massive bump up in the Korean equity market is one example. The fact that getting to $1 trillion is a much shortened time frame. Clearly, the old picks and shovels popularity with semiconductors exploding, and that really it's momentum. If we're looking at the factors in the economy today, it's AI that's powering the momentum. New highs being reached. Agnostic markets when it comes to most things like geopolitics, debasement trade potentially, long-term government rates being what they are. I'd love to have your views on where we are in equity markets today, and is this time for caution?
I mean, I think you said it well. It's AI based. It's heavily like industry specific and concentrated. Historically, if you're kind of, if you're investing in momentum, you're typically a little bit more diversified, whereas it is just, I mean, I was reading a paper by Man Group with some numbers on it, but unfortunately I didn't commit them to memory. But I mean, yeah, it's ultimately a risk. I mean, you're heavily impacted by earnings misses at that point. You're going to be heavily impacted by, if somebody does achieve super intelligence and the rest of us becomes the overlord to the rest of us, right? I mean, it's going to be, I joke, but, ultimately, like, being that concentrated in any trade, I think is going to be a risk, and it's going to be difficult. And I personally would feel uncomfortable by it. I think there's being able to brag to your buddies about, how well you're doing, but then there's also being able to sleep at night and knowing that you're a long-term investor, who's not going to be so highly indexed to the whims of, a handful of companies. But I would love y'all's thoughts too.
Yeah, I know. I mean, I just can ask an extended question on that, not only about what your thoughts are on the current equity market situation. You could comment on concentration on these large multi-trillion-dollar companies that are larger in their own right than entire country stock markets. And also, you're all allocators here. How do you think about your equity allocation now? Do you have to kind of recalibrate it from a risk-reward standpoint, or just think it's going to behave differently? You can start with Christie and move around.
I mean, I will say, I think it's kind of interesting how quickly this has happened, because I think it was 2018 when Apple first hit $1 trillion, and now I think they're at, the 4 trillion now or something like that. I mean, Google's got over $100 billion on its balance sheet. I think that, I mean, obviously you're going to have to rethink, how you're investing, or you just lean into it. I mean, you have the ability, there's inverse ETFs. You can obviously hedge out exposure if you really want to. But ultimately, I'm a little bit more boring and old school. I would rather size it appropriately and maybe, kind of size down, take my wins as they come. And I'd probably be part of the group that's sitting the 8 trillion in cash.
The money market fund, yes. We do have a slide for that. This is the money market fund on the side, 8.3 trillion, new record high, and plenty of dry powder there for FOMO. If we're going to blend both metaphors together there.
I don't think valuations are at a point where I would be, really excited to just, allocate to equity. I mean, and by that, I mean, like at the very highest end of the range. So, in my personal portfolio and in the groups that I advise, particularly on the family office side, it's, actually family office, they're running a little bit hotter, at least the groups that I work with. But with a focus on cutting back to more of a target allocation, specifically, and staying really close to that target versus trying to take a big, guess one way or the other. I don't know, I wouldn't, because I also wouldn't feel comfortable betting against this market right now. So
Yeah, despite the chart I have here showing the risk premium is getting such a low relative to bonds, and the dividend yield's pretty meager and mediocre, but what a surprise that would be given where the equity market gains are coming from.
Sure.
I'm sure we have other views in the room around the current entry point for equity markets.
Yeah, so you have fear, right? Because you have this narrowing and so forth. But I think the thing that you have to be very cognizant of watching are earnings misses.
Yeah.
And then the earnings misses are sometimes the canary in the coal mine, because do they continue? And a lot of times when you have earnings misses, they do continue. And that's kind of the thing you have to watch. Now, the situation that we're talking about today, we have experienced it before. So what do people do when this market rolls over or it broadens out? So you see, if you go back to, let's say 2000, which was probably the most equivalent time, you had the situation where the equally weighted index did extremely well. Actually, it was up, I think, 3 years in a row, 8%, where the S&P had negative returns. So you have this situation where you're like, okay, I know that people are going to go into the broader sector when this rolls over. It doesn't have to be this violent thing. It doesn't have to be all that. But I think that's where people are like, I'm going to lose my money. I'm going to. So I see you have to keep a cool head and say, why am I investing? And I have a long-term time horizon. So you keep your head cool and say, got a long-term time horizon. What would be the smart? This is going to broaden out. Other companies besides these few are also going to benefit from AI.
Yeah.
And there's still enough AI. I mean, it's like I even think back to the internet. People were still benefiting from the internet 10 years later.
Yeah.
I think back even in that time, Amazon, people were like, are they ever going to make money?
Yeah.
So it's these questions of people just saying, have a long-term time horizon, see who winners are. But the market has tons of areas to play. There isn't this, and then what are we going to do instead? If you take equities out of your allocations and go somewhere else, is that what we're going to do?
Mm-hmm.
I don't think anybody's going to do that. You're never going to hit your return targets if you do that.
Yeah.
So it's like, I got to be in this market somehow. Where can I pick
But keep it broadened out. I think that's a great point.
And earnings have been performing, right? I mean, they've actually been showing up, and so which has been bowing this market even higher. To Christie's point, you never bet against a bull market. I mean, no one can time the market. No one has a crystal ball, and but I think it's the amount of cash on the sidelines, the amount of dry powder, I mean, is a testament to the fear and the cautiousness that we're seeing amongst market participants. And I think that dry powder is not sticky capital. I mean, I think FOMO could come in and that dry powder could be deployed and just even push this market even higher. Because, markets, what is it? The Maynard Keynes markets can stay irrational longer than we can stay solvent. So this thing can go on for God knows how long. And I think it's, you have to own beta. I mean, because it's the opportunity cost is just too high for you not to be in the markets. And, you can't time the top, you can't time the bottom. So you have to participate. Otherwise you're just going to be left behind.
And I want to add something to which when the markets roll over or so forth. So right now you have probably the lowest percentage of stocks outperforming the S&P 500.
Yeah.
And if you take that situation, when it reverses, you have the largest percentage of stocks outperforming the S&P 500. So when you have the largest percentage, which job do you want to have? And I would argue I want to be a stock picker at that point.
Sure.
Because my chances of picking a stock that beat the S&P 500 is really good.
You've impacted my brain because I was thinking about that a week or two ago. And I think in some areas you're already seeing that play out a little bit. I mean, not in the US in particular, but kind of ex-US in small pockets. So
Stopping, exactly. Let's move. I mean, we're trying to move through lots of topics here, but obviously SpaceX IPO, just in terms of you harken back, I think, Ryan, to the earlier hype cycles when, and I think what's clear now is it's extremely difficult to put a model, put some of these AI companies through a model, or even in hyperscalers, given the price of tokens is a bit of a variable, demand is a complete variable. And we know with the headlines we're seeing about cutbacks and usage, that's a variable. And then we have Goldman Sachs just today, I had a headline from today, it's not on the slides, where it says SpaceX IPO, they're expecting 100x on their AI related revenues for SpaceX. So I mean, where does this number come from, and how can that be supported, and what is the range of outcomes that could perhaps be attached to that? We know there's a massive interest in the private wealth arena around getting access to this IPO. I would question why it has to be day one access or day two access. Could it not be day 90 access? I mean, when things have settled a little bit. But I'd love to hear your views on this IPO frenzy we're seeing. Is it a desire to get all of it out before some truths start to hit the fan?
I mean, I think that there's always a little bit of that with any Elon Musk company. I think he's an interesting visionary. I read the S1. This is one that I would recommend people go look at, because the first like 18 pages are pictures of rockets, which is kind of cool. You don't get that very often in S1. So I appreciated that. But in terms of, like looking at the numbers themselves, you have in 2025 a company that did 18.7 billion in revenue, so it's 100x revenue. So they'd be the 7th largest by market cap if they were, put into the index, but they'd be the 200th ranked by revenue. So their revenue right now is closer to Kellogg's, was what a friend of mine had mentioned, and that they have $29 billion in debt. They basically have 3 lines of business. Only one of them is actually profitable at the moment. There's some really interesting transactions where it appears as though SpaceX bought $150 million worth of Cybertrucks from Tesla, which was kind of a wild line item. And my point being that we saw with Tesla merging with SolarCity, and and then taking money for the Tesla Roadster to be able to stop the gap, the $300 million near bankruptcy gap that they had in the late 2010s. I think it was when they were doing the Model 3. So you just have to get really comfortable with the governance, which is messy, or it's not clean, I should say. And you have to get comfortable with the fact that you're betting long term on a person who it seems wants to go to Mars, but also, 93% of the TAM that is mentioned in their S1 is all AI related. Basically, it's priced to perfect, right? I mean, they really, like, management has to do very well. There has to be data centers in space. There will have to be colonies on the moon and Mars, which I do love the idea of a moon colony. I think that's cool. But at the same time, I don't know. There's been a big thing on the internet talking about index inclusion, I guess. Like NASDAQ changed the rules. And so I think that a lot of the desire to be a day one holder, or, stockholder, is because there will likely be a massive amount of pressure. Just between S&P and or basically index funds that mirror NASDAQ, and then S&P, you're looking at, something like 40% of the float in order to scale up. And that's even at a float adjusted rate. Yeah. That's like less than 1% in any given index. And when you're basically giving 90, or is it 87 billion in shares, it's going to be like an interesting headwind for the index holders. Yeah. Wonderful tailwind for anybody holding the stock. Yeah. Well, it's interesting. I think there's not really a fear of missing out, because if you're an index holder, you're not going to be missing out. It looks like you'll be participating whether you want to or not. So there will be that. I'm just conscious of time, and I'd like to move on to our last topic, which is very short, and geopolitics. Christie, I know you focus on this. I'd love to hear just if there is a kind of a 1-minute summary of geopolitics is clearly continuing to rage. It seems I had a suggestion that the war would not be extended, that there seems to be a bit of a détente of some kind there now. Still lots of pain to come on the oil front. Probably it's not sorted out yet. But where does geopolitics fit in the matrix of what investors need to think about today? Is it a kind of interesting to talk about, but doesn't really move markets? Or what's your view? And we'll bring it to a close with that. I mean, I think it should if it, to the extent it doesn't. I think a lot of it is there's a lot of news. It's like, oh, it stopped. There's a ceasefire. Oh, it's on. But I mean, just like implications on fertilizer prices, which are going to impact food, which are going, or would, in farmers who impact food, which is going to come up in prices. I mean, further down the line. I think that there's all sorts of interesting ways that just, it's not a war, it's a conflict. Because I guess we didn't declare war officially, even though we know it's a war. But I do think it is important to take those things into consideration, particularly given, I mean, we're no longer in a fully globalized world. Like supply chains do fracture easily. There's a lot of fragility in the system in that regard. And so, I mean, who would have thought that, one strait could basically be the end of so many, goods and service, or so many goods that we purchase globally. And it's like one little spot, right? I mean, in terms of like relative to the world. And so I think that there are all of these interesting bottlenecks and all sorts of problems, and I'm just not creative enough to think of all of them, but I know that we should be cognizant of them.
It's training us to do, we talk about diversification and investments. I think diversification of supply chain of sources and everything else will definitely be there. I think Brian, seems like you want to say something. I was going to bring us to a close, but I'd love to hear if you have to weigh in on that.
So I do think that people have to consider geopolitics as part of it. But I think really from a perspective of what are people's optimal positions? So you're Iran, and I always think people don't play the other side. But if you were Iran, what would be optimal for you to do? They're not going to beat us militarily.
Get a bomb.
Okay, so if they're not going to beat you militarily, what have they done in the past consistently? They've consistently argued and tried to get a deal.
Yeah.
So if they pursue any type of nuclear weapon, we reward them not to do it.
Yeah.
And that's what they play for. And also the US has a 4-year term for president. At least we currently do. And if you can wait it out, then you will have a new person in charge that you are dealing with in the next period. So it's kind of like that is the game, and you can keep prices. If you can make those prices continue to be a nuisance, people will say, let's resolve this, whatever. That's the optimal position.
Sure.
Iran proved not to be Venezuela, as it turns out. And I think the rational outcomes are not always, or even the previous outcomes are not what we expect. And I think that's the inability equally of our press and our media to like to soundbite everything, and to which for our attention spans are short. We want quick conclusions, and I think that has probably distorted things. Well, thank you so much, everyone, particularly Christie, for your insights here. It's been a wonderful discussion. I think we probably could have extended it for a few more hours, but I think this is why it's so wonderful to bring together allocators and people who've looked at this over and over again. And thank you for the thought you put into the preparation. And thank you, everyone, for listening to today's Markets Happy Hour podcast.